Okay, welcome back. This is Investments Part 2. I'm Nevin Wallace, an investment advisor with Pelican Wealth Advisors. Let's get started. All right, getting in the stocks here, which is what, most people like, and that's what all the fun stuff is. Everybody's always talking about what's on TV all the time. So shares of a stock, represents ownership in a company. So when you own shares of Apple, you're part owner of that company. So, and then the stocks, they typically will pay, dividends, and stocks can be, very volatile. They can move up fast and they can go down fast. If you recall, not too long ago, a few minutes ago, we said when we were talking about stocks that there's common stock and there's preferred stock. And the common stock is what you're pretty much hearing everybody usually talk about. The preferred stock is, considered a fixed income asset that will pay you a higher dividend. When we're talking about stocks, they can be classified into three categories. Basically, there's three basic categories. There's your small cap, your mid cap, and your large cap stocks. And there's, there's risk that just lines up right with that. Like on the slide here, your small cap stocks are going to be your most risky. Getting up to your large cap are going to be, theoretically, the way it works is they're going to be less risky, but there's still a lot of risk involved. And then there's, growth stocks, value stocks, income stocks, blue chip stocks. So what are they? What is that? So a value stock is a stock that, is undervalued. Maybe it's gotten beat up for a very long time. If you look at their chart, it's just been like going down the, a mountainside basically. But maybe it's it's still not like a terrible company, and they're not going to be going away anywhere because, maybe they're largely integrated in our way of life or whatever. So there's value there. That would be considered a value stock because it's gone down for like the last 2 years, and it's looking attractive now, and maybe there's going to be some kind of turnaround. So that's value stock, getting it while the price is low or after it's been beat up for a while. Then you've got your growth stocks, which, are kind of like story stocks, I guess I would say, in a way. They're your high flying stocks, your momentum stocks that, you're hearing everybody talking about. Oh man, I made 30-40% gain on Apple or something over the last like 5 months, and that's a growth stock. So, and those are going to be moving a lot faster up or down. Then you got your income stocks, which those are ones that we would say just pay high dividends, your income stocks. So that's like what comes to mind to me is always AT&T because they have a very high dividend. Then you got your blue chip stocks. So the blue chip stocks are like all the stocks, the companies that are in the Dow Jones, the Dow Jones 30, what everybody's always looking at every day. So they're your large cap. They're probably the, up there with being the least risky or some of the safest stocks that you could be in. So and they're large cap, like I said. And then we got listed here American Depository Receipts, ADRs. Those are stocks that are foreign companies that you can purchase shares of their stock here in the US. So, for example, BP comes to mind. They're a British oil company, but you can buy shares of BP here, just like you would buy shares of Microsoft or Apple or ExxonMobil, but it's an ADR, an American Depository Receipt. Sometimes, depending on, the firm you use, or not the firm, but the brokerage that you use to buy and sell through, there could be an additional commission on these. All right, so the advantages and disadvantages of stocks, like I have been saying, the advantages is, you're becoming an owner in the company. You receive dividends, hopefully as well as capital appreciation because you've got something good. And they're very liquid. They're very easy to buy and sell all day long whenever the market's open, 9 to 4:30, or 9 to 4, I'm sorry. historically they've had the some of the best returns out there, long term. And some of the disadvantages are that stocks are subject to a lot of volatility. For example, they could miss earnings, and earnings reported 4 times a year. And it could get ugly if they miss earnings, potentially. You could see good names drop 10% in a day if they have a bad earnings report and bad forward guidance or whatnot. So there's greater risk to your principal, and stocks would not be appropriate for people in the short term. Like I was saying in the beginning, you want to use stocks for long-term thinking and long-term investing. In the short term, you're going to be looking at securities or investments that are focused on interest, and dividends that are being paid. All right, so next would be mutual funds. So I think a lot of people are familiar with mutual funds. If you ever worked for a company and you had a 401k, more likely than not, your investment options in there were mutual funds. So what they are is they're pooled money, and they're called an open-end fund. So if you choose to invest in a mutual fund and you're signed into your account and you find a fund that you're going to buy, or even if you have an advisor and they're doing it for you, at 4 o'clock is when the order tickets go in for mutual funds. And at that point in time, the mutual fund company is going to receive the inflow of all, from all over the place of everybody who's investing in the fund for that day, new money, and then they create new shares as the money comes in. So that's called an open-end fund. They are managed by other companies that have portfolio managers there. So there may be one company that exists out there, but they might have 100 different mutual funds under their company with all the different portfolio managers that are managing all those different mutual funds. So, and then inside the mutual fund, it's like a basket of stocks in there. There could be 100, 200, 300, depends on what exactly the mutual fund is. But it's going to be a basket of stocks, or it could be a bond fund, and you could be a basket of bonds in there. Okay, so there's 3 major categories of mutual funds. As I was saying just a minute ago, there's your bond mutual funds, your stock mutual funds, there's money market mutual funds. There's mutual funds that kind of follow the whole risk spectrum. So your low risk mutual funds would be your money market funds. Then there's stock mutual funds, bond mutual funds, there's aggressive stock mutual funds, there's all different kinds. There's sector specific mutual funds, just like there could be, just like there's sector specific ETFs and stuff, which I'm about to get into. And then you've also got your active mutual funds and your passively managed mutual funds. So that just means that the portfolio manager or the fund company is either actively managing the fund, day to day, changing out holdings or whatnot, or they're just, it's passive and they just pick some stuff and it sits there for a year and then they reassess or whatever. So that's kind of how all that works with the mutual funds. So the advantages with mutual funds is, you get diversification. As I said, they're a basket of companies or a basket of bonds. They're professionally managed by the portfolio managers, then all the analysts they've got working there for them and everything too. You can invest small amounts of money at a time, and they're liquid. And then some of the disadvantages is that they can fluctuate, just like I was saying, stocks can fluctuate, but not necessarily to the same degree as an individual stock. One of the things is you can kind of smooth out some of your risk by using something like a mutual fund versus some individual stocks in your account. Because if you have some individuals, there's going to be more stocks likely in the mutual fund that can absorb some of the losses or poor performers of others will be made up by you have, say you have, 2 or 3 or 4 bad performers in the mutual fund, but then you got, 10 or 15 good performers in the mutual fund, so that outweighs it. So you tend to see less price fluctuation and volatility, I would say, in mutual funds versus owning an individual stock. Oh, and this is another thing with mutual funds is that, you got to be careful buying mutual funds at the end of a year because it could be extremely tax inefficient. What I'm saying is that at the end of the year, a lot of mutual funds, they distribute their capital gains for the year. They give out a big dividend to all the mutual fund holders. If, say, if you bought a mutual fund and you buy, I don't know, say December 2nd, and you were owner by then at that point in time, and so you just got in, and then the date that the fund company uses as their cutoff for recipients of those capital gains for the year, maybe that's 3 days later. So now you, who weren't even holding the fund the whole time, just received this big capital gain in the form of a dividend that now you owe taxes on right at the end of the year when you haven't even had the thing, for a month. So that's just something to be aware of. I would advise to not necessarily go and invest a whole bunch of money in mutual funds around the end of the year, is what I'm saying there. With mutual funds in the past, they've started to get a bad rap with, the fees and having high fees and expenses and stuff like that. So, there are fees and costs associated with mutual funds, and they have there could be a load fee, which, could be 5% of whatever you put in. They just take right off the top up front as a 5% load. It could be smaller or bigger. I was just throwing that out there. They have fees, they have annual fees. So, and that, can range, it can be very low up to 1% or greater. So that's, just another thing to educate yourself about and be aware of that exists. All right, next we've got ETFs. So ETFs, as I mentioned, are similar to mutual funds in that they are a basket of stocks that are inside there. So, if you went and looked up some ETF and the holdings inside there, you might see, 50 stocks, 20 stocks, maybe even 100 stocks or more, depending if it's an ETF that's tracking like an index or something. So there's ETFs for, oh man, so much stuff. It's pretty amazing. There's all these sector ETFs for, I don't know, like telecom ETFs, healthcare ETFs, energy ETFs, and then that can get broken down even into like oil driller ETFs, or more like your energy infrastructure companies, ETFs for that. Technology ETFs, software ETFs, semiconductor ETFs. So there's so many things, and there's various country ETFs. There's Israel ETF, Turkey ETF, UK. So there's almost an ETF for anything, commodities, gold. So I think you get the point there. So there's a lot you can do with ETFs is what you should understand. That's what you should gather from this. They can be traded throughout the day. Anytime the market's open, you can buy an ETF or you can sell an ETF, which, as I said, is different than the mutual fund, which you can only buy and sell at 4 o'clock when the market closes each day. So these are very liquid. You can buy or sell in the middle of the day. Got to watch out about buying mutual funds at the end of the year because of those large capital gain distributions the fund companies send out. These don't have that. So at the end of the year, they could be a more tax efficient vehicle. All right, and then these are your alternative investments. Real estate, REITs, which stands for Real Estate Investment Trust, and there are public REITs. There's non-publicly traded REITs. I just would like to make a point on that non-publicly traded REITs. Just be very careful with those. We've seen a lot of people who have been significantly hurt from non-publicly traded REITs. And, they go to, I'm not saying any company names here or anything like that, but they go to one of these, places that are in your city that are on one of the street corners, very, large company. They have commercials on TV and everything. We've had people come to us from those places. They've been advised to buy or invest their money in non-publicly traded REITs that are, literally 100% illiquid. Like, you cannot get out. Your money is there, and then they pay you, that you get paid an interest rate. But we've just seen a lot of people come to our firm from these places holding these, and they've lost a lot of money, and they're not going to be able to get it back. So I would just caution you on those. There's publicly traded REITs, which we use. You can buy and sell just like stocks. There's stock options, which some of you may be familiar with from your employer. Futures and commodities, which we're not going to talk anymore about that other than saying that right here. Collectibles, that's another form of alternative investment. It's basically an alternative investment is essentially anything that I, pretty much didn't cover here. All right, dollar cost averaging. If you don't know what that is, if you have a 401k, maybe at the company you work for or with, or if you have a company and you have a 401k and you put money into it regularly on a regular basis, like every month when you do payroll, or if you're an employee and you're contributing to a 401k out of every paycheck, that's dollar cost averaging. It's investing a regular determined amount over specific intervals, maybe every month, every quarter, or whatever, however it is. It's just investing the same amount of money on a regular basis over a period of time. The whole reason for that is that, maybe one, that's the only thing you can do. That's your only option because you don't have a big lump sum of money to invest with. But the other reason why you would do that is to try to reduce risk and volatility, as opposed to just investing one huge lump sum of money at a single point in time. You could get hurt from that if things take a downturn shortly afterwards, where if you're dollar cost averaging in like a little bit at a time, like say, it could be anything, it's totally customizable, but as opposed to putting a whole lump sum in up in the beginning, you put a little bit in, say like I was saying, shortly thereafter, things take a downswing, and then you put a little bit more in, and then maybe things just kind of like stagnate out around there after the market's fallen, and then the next month has come up and it's time for you to put another, and invest your next contribution, or your next dollar cost averaging amount, and then maybe the market starts going up again a couple months later or whatnot, and then you're just slowly keep putting money in, and that's to smooth out volatility. All right, so that's an important thing also to understand and be aware of. All right, so here, if you're conservative, this is just an example of what a conservative allocation model, should roughly look like. It doesn't have to be exactly like this, but it's something like this. The main point here is that you have a much smaller amount of stocks in a conservative portfolio or account. You're going to have less stocks and more bonds in a conservative account, and you could have more alternatives because you could have REITs in there or something like that. So in this example, we're just saying, you'd have 50% bonds, maybe 25% REITs or something like that, and then the remainder is 25% stocks. That's kind of how a conservative portfolio should roughly be set up. Now, if you're looking at a moderate portfolio, that, I would say has always been your classic 60-40. arrangement where it's 60% stocks and 40% bonds. But what we're saying here in this example is that it's, it could be 50% stocks, 40% bonds, and then 10% alternatives like REITs and gold or something. I mean, I'm not saying all 10% gold or anything like that, but a combination, the 10% could be a combination of REITs, real estate, and precious metals or something like that. So that would entail your moderate portfolio example. And then an aggressive portfolio. In this example, we're saying it would be, much heavier equities or stocks, because you can call stocks equities. So it's going to be it's going to be overweight stocks, and it's going to have less bonds and less alternatives. So in this example, we're saying 75% stocks, 15% bonds, 10% alternatives. Man, it could be 90% stocks, 10% alternatives, or 10% bonds. It could be 100% stocks. The point is, the more stocks you have, the more aggressive your portfolio is. And the whole point of that is to focus on growth. This is just a general rule of thumb, is like the rule of 100, to determine how you should allocate things. And I'm not saying that this is universally true for everybody, but it's just a rule of thumb that you would just take 100 minus your current age, and that should equal the percentage of stocks that should be inside your portfolio. All right, here we're just looking at, this is very busy, but across the top in black, you see years, 2009, 10, 2011, 2012, all the way up to 2019 year to date. And what this is showing us is that, let's just look at 2018 column, on closer to the right side. You see at the top for 2018, the top performing sector in the stock market was healthcare. It was up 6.5% for that year. The worst performing sector for the year, if you look down at the bottom, was energy, with a negative 18.1%. And that's in the 2018 column we're looking at. So the point here is that, now go and look at 2019, the next column over to the right, year to date, healthcare is all the way at the bottom, and energy stayed at the bottom. And what rose to the top was, the very top performer for 2019 was information technology, 29%. So what we're just looking at here is what's called sector rotation. What may be up last year, maybe the best performer last year, could be the worst performer next year. It could be the worst performer last year is the best one this year. Where's an example? An example of that would be 2015 and 2016, if you look there. You see in the 2015 column, the worst performing sector was energy, down 21%. The next year, in 2016, it was the number one performing sector. So these are just the types of things that you need to be watching and understanding and looking out for, because you're going to need to, your portfolio will need to be updated and rebalanced and reallocated at times, to keep up with this. And then that concludes the investment piece of this educational series. Here's just a brief moment to review the disclaimer. All right, thanks for listening, and I hope that you got some good information out of here. All right, thank you and take care.